We've seen that the Johannesburg Stock Exchange is the place that investors will go in order to buy or to sell shares, and that brings us to the very important question, what exactly is a share? Now, this is dealt with in lesson 3 of the workbook, and we need to find out a little bit more about the exact makeup of a share. Well, the best way we could describe a share is to say that it is a little bit of ownership, and that if you hold shares in a public company or a listed company, that means that you are a part owner of that company. Say, for argument's sake, a company has issued 1 million shares, and we refer to this as the issued share capital. This is the number of shares that are held by owners or investors out there in the marketplace. If we've issued 1 million shares and you, for argument's sake, personally own 200,000 of those shares, then you would own 20% of that company. If, for argument's sake, somebody else owns 600,000 of those shares, of the 1 million shares that are in issue, then that person owns 60% of the company. We would describe this person as the majority shareholder, because anybody who owns 51% or more of the company would be described as the owner of that company. This person holds the majority of shares, and therefore that person will determine how the business is run and will obviously elect the board of directors to run that business on their behalf. Now, we must distinguish in our mind the difference between what I've described here as issued share capital. These are the shares that have actually been sold into the public. There is another term called authorized capital, and if there are, for argument's sake, 2 million authorized shares, of which 1 million have been issued, then it means that the company still has available another 1 million shares that it could issue to the public if it wants to raise additional funds. So in your mind, please separate these two. Authorized capital is the number of shares the company has available to issue to the public, whereas issued share capital is the number of shares that the public has in fact taken up from that company. Now, when we look at this whole issue of what is a share, why should we invest into a share? We need to consider the benefits. What would you benefit from investing into a share on the Johannesburg Stock Exchange? What advantage does it offer you? Well, there are two primary advantages to investing in shares. Now, before I discuss those two advantages, let me just detail the difference between various kinds of shares that are available to invest in. And then let's go back to answering that question, what benefit is in it for me? The first category of shares are known as preference shares. In other words, these are shares that carry with them a relatively fixed rate of return. If, for example, I buy a 12% preference share, it's not very dissimilar to buying or paying money into a fixed deposit account at a bank. Because as a buyer of a 12% preference share, I know that I will receive 12% return in the first year that the company makes a profit. So if I invest 100 Rand into these preference shares, I know that at the end of that year, if the company makes a profit, I will receive a 12% return. Now, whenever you talk about shares, you never talk about a 12% return, you talk about a 12% dividend. Because a dividend is the word that we use when we describe the return that you get from having invested in a share. It's the portion that the company pays out of profits to its shareholders as a return for the amount that they've invested into that company. And note that one very important aspect is that the dividend is only paid to a preference shareholder if the company makes a profit. If in the second year the company makes no profit at all, then you will receive no dividend. However, many preference shares are known as cumulative, which means that what I did not receive in year 2, I may well receive in year 3 if the company makes sufficiently large profits. So the 12 Rand that I missed on in year 2 may well be paid out in year 3, so I may receive 24 Rand, 12 of that being from last year's dividend and 12 being from the current year's dividend. Now this is obviously an investment option that falls on the low end of the risk-return continuum, because you're not taking much risk at all. You know that so long as the company is profitable, you are realizing a 12% return or dividend. However, a different category of shares, and this is the category that we are interested in as potential investors on the Johannesburg Stock Exchange, a different category are what are known as ordinary shares. Another word for these is the word equity. They are known as equities. And an ordinary share is very different from a preference share, because an ordinary share is only paid out a dividend if the company makes a profit, and that profit is first of all applied against the preference shareholders. So the company's profit, there has to be something left over after the preference shareholders are paid. But there's a second restraint, and that is if the directors of the company agree to paying out the dividend. Now, the directors of the company are those individuals whose job it is to run the company, to decide where to go, what strategic route to take, how to build a business, what to do about going to where they are aiming at. These are the people ultimately responsible for running the company. And the directors, remember, are always appointed by the shareholders. So ultimately, if I am a majority shareholder and I own more than 51% of this company, I will control who the directors are, and therefore I ultimately will control that company. But I will entrust the day-to-day running of the company to these people who are called directors. And one of the tasks that the directors have is to decide whether or not to pay a dividend. Even if there are profits available, the directors can elect to keep that profit in the company to grow the business, which indirectly, of course, will benefit you, or they can retain some of those profits and they can distribute some of the profits out to you as a shareholder in the form of what we've just described as a dividend. But it's possible for a company to make no profit at all, and therefore you won't get dividends. It's also possible for a company to make a profit, and you also don't get dividends because the directors have not sanctioned that dividend. So this, getting back to the original question I posed, what's in it for me as an ordinary shareholder, and this is the area of interest, this is what we're going to be basing the entire course around. What's in it for me in the first instance is a dividend if the directors of the company sanction that and if the profit is available to pay it. Now, if you were to investigate the kinds of dividends that are paid out by companies, you may in fact be disappointed. You may in fact think, well, it isn't all that much. So there has to be something else in it for me. There has to be another reason as to why I should be enticed into investing in shares on the Johannesburg Stock Exchange. And the answer to that question is yes, very definitely. There is another component that is called a capital gain. One of the aspects of ordinary shares is that they have no fixed value. Once upon a time, they had a value called a par value. When they were first made available to the public, let's say at 1 Rand, that was the value that was attached to them. But immediately that they come onto the stock market, that value is no longer relevant. In fact, the shares can go up from 1 Rand to 2 Rand or to 3 Rand, depending upon how well the company is doing. So if we look at Pick and Pay shares today versus the value that they were at when they were first offered to the market, we will notice that today they are many, many rands above what they were originally made available at. In other words, the share price of those Pick and Pay shares has gone up significantly. And the reason for that is that the company is now much bigger. It's grown, it's expanded. So those people who got involved in the primary purchase of shares in Pick and Pay, if they've held onto those shares, they're obviously worth a lot more today. So if I was one of those original investors and I paid 1 Rand to buy a share, and I'm going to use 1 Rand here, but remember that share prices are always quoted in cents, so I would talk about paying 100 cents rather than 1 Rand. But for simplicity's sake, if I were to have paid 1 rand for a share, and today they're worth 16 rand, I've made myself a capital gain. Because if I elect to sell that share, and there's a willing buyer at 16 rand, then I will have made myself a capital gain of 15 rand per share held. And that's the magic of the stock market, is the fact that share prices are not fixed. They move up and down as the fortunes of the business improve or get worse. And as a knowledgeable buyer of shares, I'm able to take advantage, in as much as possible, of the opportunity of making a capital gain on having bought a share at a low price and having sold it at a higher price. And effectively, this is the area that one can monopolize or capitalize on enormously, because the more knowledge you have and the more time you have available, the more you learn about the stock market, the more you can take advantage of the capital gains as share prices are moving all the time. And your objective as an investor is, of course, to buy the share when it's relatively cheap or inexpensive and to sell it at a higher price in order to realize that capital gain.